Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets related to the metals. They all seem to be interrelated anymore, but a lot of price action here in the last couple of weeks. And Miles, I've got to give you kudos going into this week, and I've really appreciated the ranges of resistance that you showed on gold and silver the last couple of weeks. And man, we just really are hitting our head right on those. So do you want to show us gold to start with this week?
Sure. We've had a great bounce in gold, which was mostly expected. I mean, we came into that multi-year massive range, 1680 to 2080. So we're talking a huge $400 range, and it wasn't surprising to see it bounce. Now, the question is it a bounce or is it a reversal? And we still don't know yet, but we have cleared into the first range that we need to, which is going to be pushing above the lows from back in about the middle of May, which we're at now at around 1790. And we have today a couple little touches above 1800. And we know whether it means anything or not, people like a lot of zeros. So the more zeros you see on a chart, the more likely people are going to place trades there. And 2 zeros is quite a few, 1800. So it's not surprising to see a little resistance there. Going forward, if gold is going to be in a reversal back up towards the top end of this big trading range, I really think we need to see gold pushing close to 1900. I know we've still got a long way to go. We're talking another $100 up, but hey, we just did 130. What's another 100?
In just a couple of weeks, we've seen a 7.5% increase. Don't get used to that type of return. You know, that sort of matches the 20-year average return, just under the 20-year average return for gold, and we did it in 2 weeks. But like you said, that's yet to play out as whether it's a valid reversal or if this is just sort of a short-term bounce.
Sure, and obviously also coming off of a pretty significant decline as well throughout the summer. Our summer doldrums are coming to an end, though. We're now coming into the middle of August, pretty soon going to be September, October. Indian wedding season, moving into the fall, tend to be pretty strong times for the yellow metal going forward. So if we can see gold push up above this last shelf we put in back through the end of May and into June before we had the dip down at the beginning of July, get above that to around 1900, a little bit of a retest either to there, maybe even down to where we're at now, but start stair-stepping up the other direction. Until that happens, my argument is always the trend continues until morale improves. So the trend technically is still down, but it's pretty arguable that we're seeing a reversal off 1680 again, especially given the seasonal nature of how gold moves.
Yeah, I agree. I tend to get bullish in August anyway. We see that on a consistent basis. And yet we do need to see some fundamentals come in behind and support that, and we'll get into some of that in a little bit. But that's a big move in gold.
Yeah, what'd you say, 7%?
7.5%.
That's pretty good. I think we can do better. Do you think we can do better?
I've seen us do better.
All right,
yes, I do.
What do we do?
How about we do better just in the last 2 weeks in a different metal? Let's transition over to silver.
What a great, totally not planned transition of ours. That sounded so relaxed and smooth. Silver up 13%.
That's right.
So no complaints there. Silver had a much deeper decline than gold percentage-wise, so it does have more to go, and silver tends to be the more volatile metal anyway. But the good news for that and for silver investors is that ratio is starting to decline again.
That's right, and that's part of our strategy, and it has been for many decades, and that is to watch those ratios and position portfolios strategically, dynamically, accordingly to what the ratios are telling us. So we've been moving a lot of metals into silver or a lot of new monies into silver. And again, we don't want clients getting used to a 13% return in 2 weeks, but it certainly helps affirm and even reaffirm the strategies and lead to compounding ounces. And really, we've been doing a lot of that here lately anyway, just from previous metals from 10 to 12 years ago that are qualifying for a ratio trade here, because the ratio was as high as 93 on this recent cycle a couple weeks ago, and it's done a sharp reversal down to 86. Still very high, but don't expect that big of a ratio swing very often either.
So silver was kind of hard stuck in the same similar concept of a trading range, but unlike gold, silver broke below it. So we did have a market floor in silver at around 21.5, like 21.45, 21.50 that we pushed below. So step one for silver obviously would be getting back above that. I would argue more importantly is getting above the high it made back kind of in June. around 22.50. I think we need to see a push above 22.50, maybe even up to like 23.50. And then a reversal back down to set the rising trend there. So silver does have a ways to go, but gold is showing that it's probably going to happen in gold, and I think the sister metal is going to get drug along with it. Percentage-wise, I still see silver outperforming gold, at least in the short term. I mean, that push back up to 90-1, we were as low as, 55, 58 not too long ago?
Well, in 2011, we got as low as 31. Right. So that shows you the huge disparity. And in 2020, we got as high as 125. So what we're starting to see here is wider swings with increased frequency. So the ratio trading strategies are actually picking up, and we're seeing ounces picked up for free over and over again in our IRA accounts and otherwise. And we're the only firm in the country doing that. So, if you want to talk about that, give us a call and we can see what metals you already own. It works well for metals that you've already acquired. It works well in the instance that you're ready to position in metals for the first time. But nothing's going to really change here over the long term. The compounding out strategy allows for growth over time in addition to spot price moves. I feel very strongly, Miles, again, fundamentally, with the weakening currencies, fiat currencies globally, with the strain on our own U.S. dollar, the purchasing power, all of that is impacting the dollar. We're watching here, this federal debt now is $30.63 trillion, and they're not slowing down the spending. We just passed another roughly $700 billion Inflation Reduction Act that's almost officially signed into law. I don't know how you reduce inflation by spending more, but that just goes to show at all costs they're going to spend more to keep things politically sensitively in the right column.
Yeah, I've known about this for a bit. We talked about this 5 minutes ago, and I'm still making the confused face because I don't understand the title of that. How you have a spending package, and we know where the spending's coming from. Although we could be wrong, because I hear they've hired, 12 new IRS agents? How many new IRS agents? It was 12 or 15 new IRS
18,
agents?
18,000.
Okay, yeah.
So 87,000 new IRS agents. Think about that. Now, if that doesn't raise red flags.
Maybe that's how you solve the inflation problem.
That's right.
You just do the tax raise.
There you go. You do the tax raise, and you also slow down economic growth by going after the higher earners, right, and taking more of what the government thinks is theirs. That'll certainly stifle economic growth and slow inflation.
Sure. Well, the equities market has had a bounce. I mentioned a couple weeks ago we needed to see 33.3 on the Dow. That's been kind of the Dow's line in the sand. Where are we at as far as this recording? 33,291, so I'm close.
There you go.
It's likely we'll see the Dow go ahead and push above this number, just like I think gold and silver are going to as well, because despite their best efforts, the U.S. dollar is on a pretty strong decline, down about 4% since we hit that kind of highest point many years ago, and we're, 2002, 2003, I think the strongest dollar. Mm-hmm. And now we're back down about 4%, and I think we're going to go down as far as the 2016 high of around 104. And personally, I think the dollar's coming on this move down at least somewhere between like 95.5 and 97. So despite the save us from inflation plan of $700 billion of additional spending, probably through inflation, and despite the interest rate rises and the Federal Reserve's desperate attempt to save us from inflation rates, the dollar's still going down. It's not getting stronger. So how much of this is reality? How much of this is the rises in the dollar was just anticipatory? Free market, buy the rumor, sell the news. Well, we bought the rumor. The rumor isn't a rumor anymore. They are raising interest rates, and now we're going to let the free market decide what the value of the dollar actually is. And this is a global dollar denominated, right? We're looking not just at how the dollar is going to react here domestically. Great. Gas prices are down. They're still like $4.60 on average across the country, something like that. Still like twice what it was just a handful of years ago. But you're also looking at how the dollar is strengthening in terms of other currencies. We're all in life rafts, just which life raft has the least holes in it.
Well, that's the biggest issue, is it's relative to other currencies. The dollar hasn't gained, and we've said this on the show a lot, but now we're starting to see it turn down because finally other central banks are starting to have to do the same. So the European Central Bank a few weeks ago finally had to raise rates for the first time. They're raising rates again. And they're very concerned. Like, they see what's happening, and they're now going to attack inflation because they don't feel like in Europe that inflation is going to peak until around October, and it won't be until it's exceeded 14%. And then it's going to take until 2025, in their estimate, to get back down to a normal inflationary rate in the 2% range. So you're in for a long, hard road. And what they came out and said is that, unfortunately, you're going to see that coupled with a very painful reduction in real wages. So what we haven't seen yet, Miles, is the dollar turn down because of other central banks doing the significant rate hikes that we're doing. That's been strong U.S. dollar policy when measured in the U.S. dollar index. But that's what we were screaming about is, look, this is when you buy gold. You buy gold $100 ago and you buy gold now because the U.S. dollar index is still unsustainably high. And that comes at great expense to your employment and to your exporting. So there will be a point where it turns back down. And I think that the Federal Reserve is even going to have to pivot. I think it will be so socially and politically sensitive, as the economy turns down and the recession deepens, that they're going to have to pivot and do one of two things, either lower rates again, or they're going to have to start quantitative easing. And there's a third possibility, and that is that they're going to have to start adding to the Fed balance sheet again, not reducing it. And so any one of those things will drive gold higher.
Right. Are we Greenspan or are we Volcker? Are we going to give up the ghost as soon as things get tough, or are we going to stick to the plan of combating inflation come hell or high horse? We just don't know yet.
Yeah.
And I tend to lean more with you. I'm not optimistic of the choice.
Well, I'm not optimistic with this IRS agent push either. I mean, remember what that does. That's threatening privacy.
It does help inflation.
Yeah, that's what the claim is. But it also comes against your privacy, right? So one of the most beautiful aspects of physical gold in eternity is the privacy. Off the grid, off the radar, nobody knows you have it. It's not showing up on any of the digital balance sheets. Keep that in mind as you go to protect your own assets. Do you want them digitally hackable and traceable, or do you want it something that's in hand at home?
Well, and to close out, just because we've been tracking this the last couple weeks as we've been expecting a transition back to a bullish gold market, can't finish the show out this week without taking a look at somebody else who might think that owning a little bit of gold is not a bad idea, and that's the managed money category on the COT report.
Yeah, the Commitment of Traders report is a very, very telling weekly report that tells you exactly where the big money is going in terms of futures. It's people buying paper gold on leverage. And why don't you tell us what's transpired here in the last few weeks, Miles?
So we have talked about this over the last couple weeks, and if you have an account through our Vaulted program and you're on the Vaulted mailing list, I know we've sent a few alerts out and emails out about this. So that may be something to look into if you're not already a participant. We can definitely talk about that if you have questions about owning gold. But getting back to the COT report, these are last week's numbers. Something that we were kind of expecting is your other reportables category has been pretty aggressively long, as well as your producers are generally always short. I know in the last few weeks we've kind of talked about what these categories really mean and break down to and what the expectations are. But the managed money category has been short as the price of gold has been going down. In fact, one can argue that those are kind of two sides of the same coin. However, between 2 weeks ago and last week, the managed money category got rid of almost 32,000 short contracts and added about 7,000 long contracts. So for the first time in I don't know how long, off the top of my head, money managers are actually long gold in the futures and options contracts.
That's almost like letting the leash off. This has happened in 2015 and 2018 most recently, where we saw the COT report reflect record short positions in gold. And every time it has marked the bottom in that bear cycle to where then you saw a short-term reversal that ended up being quite a large reversal. And remember, you have gone back on this show many times and shown how 2015 was the bottom and the true reversal where we started to assume and resume a bullish market. And so it goes all the way back to that first time. And so I'm excited to see what this does with the gold price. Even if we do come back down and test, to me, the leash is off.
Right. And that's why we're going to look at it again at least one more week now as we're in this transition period and see if we can get some verification of that, because if we're looking at this week's numbers being bullish again on the COT report, then I think we can put that indicator away for a few weeks. I think we're pretty comfortable in our expectation that we're going to see gold pushing back up into the middle and eventually the top end of its trading range. You've got seasonal expectations. You've got traders pushing the price of gold up. You've got a lack of faith in the future growth of the U.S. economy. You've got the dollar significantly declining after a nice run, which is probably going to continue. You've got what is effectively appearing like a dead cat bounce in the U.S. equities market. And the only thing that seems to be keeping us afloat right now is crisis in Europe.
Excellent recap. And that's going to do it for this week's Golden Rule Radio. As always, we encourage you to give us a call and talk about your own individual portfolio at 1-800-525-9556. You can also follow us on Twitter at ICA Gold and Facebook at McIlvaney Financial.
Thanks for listening. Have a great week.